Hello friends, welcome to my second video in economics series. This video is extremely important. In this video, we are going to study two very important fundamental concepts of economics, which are circular flow of income or circular flow of money. Second, what are factors of production. Both these topics are interlinked because one cannot understand what are factors of production without understanding how money moves in economy. Both these concepts, though fundamental, but are intricately connected with higher concepts in economics like what is GDP, what is GVA, and other such concepts. So with this introduction, let us start our today's topic. In the previous video, we discussed about types of goods and services. If you haven't already watched that video, then please do go and watch that video before watching this video, because understanding what are goods and services and what are different types of goods, what are intermediate goods and what are capital goods and what is capital formation, it is difficult to understand higher concepts like factors of production, circular flow of income, and what are the different changes that are taking place in the structure and composition of factors of production, and so on and so forth. Okay, so in that video we saw that for the production of goods and services we require certain inputs, and in that video those inputs were called intermediate goods, right? In simple way we can say that intermediate goods are basically raw materials which are required in the manufacture of final goods and services. But in today's video we are going to talk about some other type of inputs, and these inputs are called factors of production. Why I am calling these as inputs? Because without these basic fundamental things, it is difficult to produce goods and services. Like intermediate goods, they are also inputs, but unlike intermediate goods, they do not get consumed in the production of good or service, right? Their character remains intact. Fine. Now, let's first have a bird's eye view of what are factors of production, and then in the next section we will see them in detail. The first factor of production, or the factor which is basic, is land. If you want to produce anything, you must first have to establish a factory or a manufacturing unit, right? For example, if you want to produce sugar, then you have to have a factory producing sugar. And where do you establish that factory? On a piece of land, right? So land is essential and is an important factor of production. Second factor of production after land is labor, right? So you have established a factory, then you need people to work in that factory, right? Hence labor becomes second factor of production. In fact, labor is one of the most important factors of production. We will see its implication in the future sections. And the third important factor of production is capital, right? You have to pay rent on this land, you have to pay salary to these employees, and you also have to source raw materials for production of a good or a service. So for all that you require money, and money is, in economics term, it is called as capital, right? So capital becomes the third important factor of production, right? So you have land, you have people who are willing to work or who need employment, and you have money. Now what do you need? You need a business plan. You need to know how are you going to integrate labor with land and capital and produce something which is worthwhile and which is in demand in the market, right? That secret sauce which helps to bring labor, land, capital, these three factors of production together is called as entrepreneurship. Entrepreneurship is basically something of a business plan or an idea or an innovation or creativity which is going to help integrate labor, land, capital and create something which is called a good or a service. I hope you have understood simple meaning of what are these four factors of production and their use in the production of goods and service. In the next section, we will go into some depth in understanding what are factors of production. In this section, we will understand what is factor payment and how the character and nature of these four factors of production is changing because of the evolving modern technologies and new products and services, right? Now let us go one by one. So we saw in the previous section there are four factors of production, right? Each factor of production adds some value in the production of good or service. Now let us understand this with a simple example. Let's say that you are establishing a sugar factory in a village, right? What do you need first? You need land to establish sugar factory, right? What value this land is going to bring in the production of this sugar from the sugar factory? Land is going to provide us space for the production of sugar, right? So the value that is being brought by land in the production of sugar is space. Second value which land can bring in the production of sugar is it will help in the production of raw material. You can also use land for the production of raw material required for the production of sugar. Which is the most important raw material for the production of sugar? Sugar cane, right? So land can also be used for producing the raw material. Now, as land is bringing these values in the production of sugar, the person who is giving this land for establishing this factory expects something in return for providing these values, right? And the payment made to the person owning this land for providing these values is called rent. So you pay rent on the land that you have used for establishing sugar factory, right? This rent that you are paying is called factor payment. There is another term used for this payment which is made to the factor of production, that is called factor cost. Now these terms that we are using, that is factor cost, factor payment, and the value created by each factor of production, these terms are going to be important if you want to understand future concepts or concepts like GDP, GVA, value addition and all. So please give proper attention to these words, right? So what is factor cost? It is a cost which the entrepreneur has to pay to a factor of production for bringing value to the production of a good or service, right? So now here land is providing this value, hence it has to be paid some factor payment, and that factor payment is rent, and it is also called as factor cost. Now labor is bringing what kind of values? Labor is bringing, first of all, skills. You need people who are skillful to produce sugar. Second, labor also brings energy, right? You want people who will be spending their energy in the production of sugar in this sugar factory, right? Now the third important thing that labor brings is time. So these three are the values being brought by labor in the production of sugar in this sugar factory. The payment given to this factor of production for bringing these values in the production of this good, which is sugar, is called wages, and this wages is factor payment given to labor, or it is a factor cost given to labor, right? Now let us understand third factor of production, that is capital. Now tell me what are the values being brought by capital in the production of sugar? It is bringing money, right? Without money it is difficult to pay factor cost to all other factors of production. It is this capital or money which is going to form the backbone of factor payment. For bringing this value, capital is paid interest, right? And this interest is factor payment or factor cost. So now we have discussed three factor payments or factor costs. So they are called costs, right? Why they are called costs? Because these are costs for the production of sugar in sugar factory. These are the basic costs you have to pay if you want to produce sugar in the sugar factory, right? Now let us understand fourth and most important factor of production called entrepreneurship. Now as we discussed in the previous section, who is an entrepreneur? Entrepreneur is the owner of the factory. Entrepreneur is the person who will bring ideas and business plans. And another important function provided by the entrepreneur is that he is the person who is going to bear the maximum risk in the production of sugar. What if this sugar factory incurs losses? What if this sugar factory never takes off? Who is going to take the losses? Labor? No. Labor is not the owner of the factory. Labor wants its wages even if the factory is in losses. The person who has given land will want rent even if the factory is making losses. So all these losses have to be borne by the entrepreneur or the owner of this company. Hence, he performs the third important function, that is, he bears the maximum risk, right? So this is the third important value being brought by entrepreneur to the production of sugar. For bringing these values, he or she must be paid something, and that payment is, or the cost for entrepreneurship is, profit, right? So this is the fourth factor payment, or this is the fourth cost that must be given in order to produce sugar. So whenever sugar is being produced, four basic costs. These are basics. There are some more costs which we will understand later, but basic costs that every company has to incur for production of any good or service are rent, wages, profit, interest. Right? Now, let us understand what is the implication of factor cost. Right? Let's say that this sugar factory produced one packet of sugar which contains some amount of sugar, right? And the cost of that one packet of sugar is 500 rupees, right? Now, tell me, how did the owner of this company, who is an entrepreneur, how did he decide that the basic cost of producing one packet of sugar for me is 500? Surely he must have taken the amount he is paying for rent, the amount he is paying for wages, the amount he is paying as interest, and then he must also have calculated how much profit he is going to make from one packet of sugar, and he would have added all these costs, these are basic costs, and would have arrived at 500 rupees, right? So this 500 rupees contains all the factor payments or the factor costs which went into the production of sugar, right? So what all it contains? Rent, wages, interest, profit. These are the costs of producing one packet of sugar. See, if you go and buy sugar in the market, what all costs it includes? It includes one important cost, that is taxes. When this sugar comes into the market, government imposes taxes, right? Hence, the price of sugar will increase. But we are not going into market yet. We are seeing what cost does the sugar factory owner or the entrepreneur has to pay for producing one packet of sugar before going to market. Now, what is the cost he has to pay? 500 rupees. Now, for simplicity, let's divide this 500 between these four factor costs or factor payments. Let's say rent is 100 rupees. Land is being paid rent, and that is 100 rupees per one packet of sugar. Let's say wages is also 100 rupees. Let's say interest on capital is also 100 rupees. And let's say the profit that entrepreneur is taking is 200 rupees. Now, why profit is more than other factor payments? Because I told you that entrepreneur is the bearer of the maximum risk. He is the owner. Now, this 500, which is factor payment or factor cost for the production of one packet of sugar, is actually the value added by each factor of production. See, 100 plus 100 plus 200 plus 100. So it combines to be 500, right? Now let us try to put this example in the next section and understand what is circular flow of income. Understanding circular flow of income is extremely important because it is going to help us understand what is GDP, and it is also going to help us understand how GDP is calculated by different methods. Second thing, circular flow of income is extremely essential for government. For example, for making fiscal policy, government looks at flow of income, how the money is flowing in economy, what type of goods and services are being produced by the firms, what type of goods and services are being bought by the households, and how the money is moving from households to firm and firms to households. All these things are taken into account by government to make fiscal policy. Second important agency in the economy is central bank. In India, that is RBI. So to make monetary policy, RBI uses how the money is flowing in the economy and how much money is being used for the purchase of goods and services, and how much money is being invested by the firms in the production of goods and services. All these things are taken into account by RBI to make monetary policy, right? Now, let us try to understand in simple terms what is circular flow of income and how it happens. I'll give you one simple example before going into this section. Let's say that you are employing a housemaid. You are paying 1000 rupees per day to the housemaid. You are also the owner of a bakery. Now, let's assume that your housemaid is using that 1000 rupees to buy stuff from your own bakery. So what is happening here? You are paying 1000 rupees to the housemaid. She is taking that money and she is coming back to your bakery to buy 1000 rupees worth of bakery items. So what happened? The money that you gave to the housemaid came back to you in the form of income. The money you gave was expenditure. The money that you received through your bakery is income, right? This is very much basic example of circular flow of income or circular flow of money. That is, money moves from one actor in economy to the other and to the same actor back. Now let us understand this by taking the example of that sugar factory that we discussed in the previous section. Here Is that sugar factory? Okay. Now, all the households in this village, let's say that all these households are working in sugar factory only. Fine. And one of the household members is the owner of this sugar factory. Meaning what? All the 4 factors of production are owned by households, right? So households are providing factors of production, meaning factor service, right? Which is also called as value. We discussed this in previous section. If you haven't understood it, rewind and watch that section again. As we discussed in the previous section, what is the cost of that one packet of sugar? That is 500, right? Now, households are providing factor service. It is like the housemaid example that we discussed. It is like housemaid is providing service to the owner or you, right? So, factor service, meaning value is being added by these factors of production in the production of sugar, right? That is factor service. Now, what we discussed in the previous section, for providing these factor services, all the 4 factors of production are given a payment, and that payment is called factor payment or factor cost. And what was the factor cost that we discussed in the previous section? It was 500 rupees, right? Land rent was 100 rupees, interest for capital was 100 rupees, wages were 100 rupees, and 200 rupees was profit. So total factor payment was 500 rupees, right? And what was the cost of one packet of sugar? It should be 500 rupees because total value is 500, right? Hence the cost, that is factor cost of one packet of sugar is 500. So now let us say that when these households receive their factor payment, that is 500 rupees, these households spend that money to buy sugar from the sugar mill. Then what will be the total spending made by the households? Obviously 500 rupees, because that is the factor payment they received from the sugar mill, right? So when households are giving 500 rupees to the firm for buying sugar, that is one packet of sugar, then firm will supply that sugar to the household. And what is the cost of one packet of sugar? Again 500 rupees. Now here is an interesting thing. You see, the factor payment was 500 rupees and the households used that to buy sugar from the sugar factory, and that value of that spending was 500 rupees, and the cost of that sugar, one packet of sugar, as we saw, is also 500 rupees. Now this is basic example of how money flows in economy. If you see your own town or city, you can easily divide broadly the whole economy of your city or town into 2 basic components. And what are those components? One is producers and second component consumers. Producers are made up of firms or factories. Consumers are made up of households. And the beautiful thing of circular flow of income, as we saw in the example of housemaid, is that money flows from consumers to firms. Here 500 is being spent, and it again flows back from producers to consumers in the form of factor payment. You see, 500 is again moving back, and it is again moving back to firms. It is a simple example. Obviously, not everyone will purchase sugar only in a village, right? They will spend some money for buying cycles, tractors, and agricultural materials, and cloths and other items. Now, we have simplified that whole economic structure into this simple model to understand how money flows in the form of a circle in economy. Understood? Now, here lies the secret for calculating GDP. So in the next section, we are going to study GDP and GVA in detail, but here we are going to see just what and how GDP is calculated and where exactly GDP is calculated. Now, if we calculate GDP of this village economy at point B, that is at the point where goods are being supplied from this sugar factory to households. Now, what is the value of these goods and services? 500 rupees. So we can say that GDP by product method, that is the value of product, is 500 rupees. Now, what is this? As we discussed, this is the factor payment for factor services being provided by factors of production. Now, what is this for households? For households, this is the income that they are getting for providing their service or for providing value, right? Now, this is the income. So this becomes the second method of calculating GDP, that is GDP by income method. Now how much is GDP by income method? You can see that it is also 500 rupees, right? Now here also there is some movement of money. What is happening? Households are spending money to buy goods and services from this factory or firm. Now how much they are spending? 500 rupees. Now what is this? This is the expenditure being made by the households. This was the income, but this is expenditure. So if we calculate GDP at this point, that is point A, then it becomes GDP by expenditure method. And how much is that? It is rupees 500, right? So this is GDP by product method. If we calculate the value of final product which is being supplied from firms to households, and it is GDP by income method, if we see what income is being earned by households for providing factor service or value to the production of sugar in this sugar factory, then it is also 500 rupees. And if we calculate GDP by expenditure method, then it will calculate what is the total expenditure being made by the households on the final goods and services being supplied by this firm. That also is 500 rupees. One interesting point to note here is, if we calculate GDP by product method, it is also 500. If we calculate GDP by income method, it is also 500. And if we calculate GDP by expenditure method, it is also 500. So theoretically, if we calculate GDP by any of these three methods, it must come to be same. Why it should be same? Because all the income that households are getting, they will spend it, and that expenditure must be same as their income, right? This is the income, they will spend all of that, then income must be same as expenditure. So it is 500 rupees. And if they spend 500 rupees, then they must get goods worth of 500 rupees. And that is the final value of this good, which is one packet of sugar. So theoretically speaking, if we calculate GDP by any of these three methods, product method, income method, or expenditure method, all of these three must come to be same. Now, as we told in the beginning, this is a simplified model. In the next section, we will complicate this model a bit to see that sometimes money escapes from this model or money is injected in the model. Now, what is the amount of money being circulated now in this simplified model? 500 rupees. What if households do not spend all their 500 rupees? If households or these factors of production save 100 rupees, then do you think expenditure will be 500? No, it will be 400. So what happened? Households saved 100. Now that 100 becomes ejection of money from the circular flow. That complication of this model we will see in the next section. So here we studied simple circular flow of income without any outflow or inflow of money. Now let us complicate this a bit and understanding what are other factors which will bring in money into this circular flow or will remove money from this circular flow. Now before understanding this, let me tell you one thing. Don't get confused about these items. We will see these items only superficially in this video. We will be dealing with these items in depth in future videos. So this is just for your understanding for future reference. Now we saw that the total money which was spent on sugar was 500 and total worth of final good, that is one packet of sugar, was also 500, and total amount paid to the households for giving factor service was also 500. So 500 is the GDP of this simple village economy. Fine. Now let's complicate this model a bit. Now you must be aware that government gives money without expecting anything in return. That type of money which is given without expecting that money to come back is called transfer payment. Can you give me some example of transfer payments? If you have heard of new scheme by the central government called PM Kisan, then you will know that central government is giving 6,000 rupees in 3 installments to all the farmers, right? And this 6,000 rupees need not be returned by the farmers. So this is one-way payment. So this one-way payment which is received by the farmers, don't you think this is injection of money? Meaning this money is being injected into this circular flow of money. It was not part of GDP, but it was injected from outside. So don't you think this injection of money through transfer payment by the government is going to increase the availability of money? It is injection of money. And this firm was producing sugar and all that sugar was being bought by households. Now what if this firm decides to export some sugar to a foreign country? Now if the sugar is exported, what happens? For example, let's say 2 packets of sugar was exported. And what is the worth of 2 packets? 1,000 rupees. Now don't you think this 1000 rupees that this firm earned by exporting 2 packets into some foreign country is an injection of money? It came from outside, not from within the economy. Now let's say this is not a village economy but economy of India. Now this 1000 rupees was earned not from Indians but from foreigners, right? So this is an injection of money. So exports bring money into economy. Third important is investments, and this is also very important. Now what is investment? For example, we saw that firm or the owner of the firm, that is entrepreneur, was spending all his factor payment, which was rupees 200 for buying sugar. What if he does not buy sugar worth of 200? He buys sugar worth of only 100 rupees and invests the remaining 100 rupees. Now don't you think this 100 rupees is an injection of money into the circular flow of income? He did not invest to buy goods, but he invested that to, let's say, to increase the production in this firm. So investment is also injection of money. If you are not understanding these things in depth, then don't worry, because we will be understanding them in future videos. Okay, I'm just giving you a brief overview of how money can be brought in and taken out from this model. Next, what is ejection of money? Now here we saw that households are being paid factor payment for factor service. 500 is being paid to households. There is tax also, right? Now in real economy, you will see that government imposes taxes on what you earn. Let's say 500 was earned by the factors of production, but if 100 rupees is taken away by the government for taxes, then how much money is left for the factors of production for spending on the sugar? 400 rupees. Now 100 rupees was taken away from the economy, so that is ejection of money. Second, imports. Now let's say households did not spend all their 500 rupees for buying sugar from the factory. They thought that this sugar is of low quality. They want to spend 200 rupees. Matlab some of the households decided to spend their money to buy sugar from outside. Now don't you think this 200 was taken away from the economy? Now the remaining households can spend only 300 rupees, not 500 rupees. Now this is ejection of money. Now what if households decide we have to save money? So they start saving the money, and instead of spending 500 rupees, let's say they spend only 300 rupees. Now don't you think 200 rupees were gone from the circular flow of economy? Hence, these factors take away money from circular flow of economy. These factors bring money in. In the future videos, we will understand in depth what is the impact of government expenditure, exports, investments, taxes, imports, savings, and how these impact the GDP of a country. We will study in detail. Money supply will increase because of these factors. Money supply decreases because of these factors. So here we are going to end our discussion about circular flow of economy, factors of production, and the factors which are going to inject and eject money from the circular flow of economy. I hope that you have understood it. If you have not, then please understand it by revising the video. Second, please subscribe to the channel and spread the video as far as possible so that everyone can benefit out of it. So until next time, bye bye, study well and take care.